There's something I need to share, something I've hesitated to say publicly until now. Over 7 decades of investing, I've observed a particular signal, a flashing red light that each time I've seen it has preceded a significant market decline. Not just a minor correction, but a genuine wealth-destroying crash. What I've been seeing recently isn't just one signal, but a constellation of warning signs. It paints a picture I've witnessed before, a picture that ended badly for millions who ignored it, and very well for those who recognized it and acted accordingly. Let me take you back to 1969. The first time I truly grasped this pattern, I was managing my investment partnership. We were successful, money was flowing in, and the market seemed unstoppable. Everyone believed the good times would never end, but something troubled me. It wasn't the stock prices, the earnings reports, or the economic data. It was the behavior of those around me. Smart, educated people who should have known better. They'd stopped analyzing investments and started speculating on price movements. They weren't buying businesses. They were buying lottery tickets, convinced they couldn't lose. I recall a conversation with a successful businessman friend who had sunk his entire savings into a technology company. When I inquired about the company's earnings and competitive position, he looked at me blankly and said, "Who cares about earnings? The stock has doubled in 6 months. That's all that matters." That conversation haunted me. It signaled that the end was near. When intelligent people abandon fundamental analysis for momentum chasing, when value is forgotten in favor of price, the reckoning is coming faster than anyone expects. I closed my partnership that year, returning all the money to my investors. They thought I was crazy, accused me of abandoning them just as the party was starting. But I knew what I knew. From 1969 to 1974, the market plummeted nearly 50%. Those who criticized my conservatism watched their portfolios collapse, and many never recovered. The signal I saw then is the same signal I see now, and I want to explain it in detail so you can recognize it and protect yourself from what I believe is coming. This signal has 3 components. The first is what I call the confidence gap, the divergence between investor confidence and economic reality. When confidence is high but economic fundamentals are deteriorating, that gap becomes dangerous. The wider the gap, the more violent the eventual correction. Right now, that gap is as wide as I have ever seen it. Consumer sentiment surveys show extraordinary optimism. Retail investors are pouring money into the market at record rates, and margin debt, money borrowed to buy stocks, is at an all-time high. People aren't just confident, they are aggressive, leveraged, convinced that the only direction is up. But look at the underlying economy. Corporate earnings growth is slowing dramatically. Many companies are masking their true performance through financial engineering, stock buybacks, and aggressive accounting. The real economy, where people buy things and companies make things, isn't as strong as the stock prices suggest. For 60 years, I've tracked a metric I call operating earnings quality, which means how much of reported earnings come from actual business operations versus financial maneuvering. In healthy markets, operating earnings quality is high, with companies making money by selling products and services. In late-stage bull markets, it deteriorates as companies make their numbers through cost-cutting, one-time gains, and accounting adjustments. Right now, operating earnings quality is at its lowest level since 2007. That should concern you. The second component of the signal is what I call the amateur hour phenomenon. This is when inexperienced investors start dominating market activity. When people who have never lived through a bear market start giving investment advice, when trading becomes entertainment rather than a serious business endeavor. I see this everywhere I look right now. Social media is filled with people bragging about their trading profits. Young investors are using options to place leverage bets on individual stocks. Day trading has become a hobby. Speculating on meme stocks has become a game. And the common refrain I hear over and over is, "This will never crash. We've figured out the market. The old rules don't apply anymore." I remember hearing words back in 1999 that sound eerily familiar today. Very smart people with impressive credentials told me the internet had changed everything. Traditional valuation metrics, obsolete, they said. Companies didn't need profits, just growth. Every single one of them lost enormous sums of money when the bubble burst in 2000. The amateur hour phenomenon is particularly dangerous, I find. Amateur investors tend to make the same mistakes all at once. They pile into the same trades, use the same strategies, follow the same influencers. And when the market turns, they all run for the exits together. That's what creates crashes, not gradual declines. When everyone is positioned the same way and panics at the same time, there are no buyers, only sellers, and prices collapse. The third component, and this is what concerns me most, is what I call institutional capitulation. It's when professional investors, the people paid to be skeptical, abandon their skepticism and join the crowd. When the last bears throw in the towel and even the most conservative money managers start chasing performance because they can't afford to underperform any longer. I've been watching this happen over the past 18 months. Fund managers who built their careers on fundamental analysis have started momentum trading. Pension funds that are supposed to protect retirement savings have loaded up on speculative assets. Insurance companies that need predictable returns have reached for yield and increasingly risky investments. The institutions that are supposed to provide stability and rationality to markets have become part of the speculation. When I see all three components of this signal present at the same time, a wide confidence gap, amateur hour in full swing, and institutional capitulation, I know we're in the late stages of a market cycle. I know that the probabilities have shifted dramatically toward a significant decline, and that caution is warranted. Let me tell you specifically what I observed last month that triggered this warning. It wasn't one thing, but a series of things that, when taken together, formed a pattern I couldn't ignore. The first thing I noticed was the behavior at a charity dinner I attended. The room was full of successful business people, entrepreneurs, executives, professionals who have built real wealth over long careers. And the conversation was dominated by stock trading, not investing. People were comparing their returns from the past year like teenagers comparing video game scores. They were discussing which stocks they had flipped for quick profits, bragging about their options trades. One gentleman, a man I've known for 30 years, a conservative investor who built his wealth slowly and carefully, told me he had put 50% of his portfolio into technology stocks in the past 6 months because he couldn't stand watching others make money while he sat on the sidelines. This is a man who lived through the dot-com crash, a man who should know better, but the fear of missing out had overwhelmed his good judgment. The second thing I noticed was in the credit markets. I track credit spreads very carefully because they tell you what sophisticated lenders think about risk. When credit spreads are tight, it means lenders are confident. When they are wide, it means lenders are worried. For the past year, credit spreads have been extraordinarily tight. Lenders have been throwing money at borrowers with minimal compensation for risk. Companies with questionable finances have been able to borrow at rates not much higher than the government. That's not normal. That's euphoria. But in the past few weeks, I've seen something concerning. Credit spreads have started to widen. Not dramatically, not enough to make headlines, but enough for me to notice the sophisticated money. The money that lives and dies by credit analysis is starting to get nervous. They are starting to demand more compensation for risk. That's often the first crack in the foundation. The stock market is usually the last to know. The third thing I noticed was in the behavior of corporate insiders. These are the executives and directors who know their companies better than anyone. When insiders are buying their own stock, it's usually a good sign. When insiders are selling, it can mean many things. They might need money for personal reasons, or they might be diversifying their holdings. But when insider selling accelerates across multiple companies and multiple industries simultaneously, that's a warning sign. In the past 3 months, insider selling has reached levels I haven't seen since 2007. Executives across the technology sector, the financial sector, the industrial sector are all reducing their holdings. Not one or two executives, hundreds of them. They know something. They may not know exactly what is coming or when, but they know that current valuations are not sustainable and they're taking money off the table while they can. The fourth thing I noticed, and this is perhaps the most troubling, is the proliferation of investment products that exist primarily to extract fees from retail investors. I'm talking about leveraged ETFs that decay in value over time. I'm talking about complex structured products that promise high returns with hidden risks. I'm talking about cryptocurrency derivatives that nobody truly understands. I'm talking about private credit funds marketed to individuals who have no bus. Wall Street has a way of creating investment products late in bull markets. It's a pattern I've observed over the years. The demand is high, everyone's hungry for returns, and people stop questioning the risks. They focus only on the rewards. The complexity you see in these products, that's not accidental. It's a design choice meant to obscure the risks, to make them seem safer than they truly are. And when the market inevitably turns, those who bought these products will discover what they actually own. It won't be pretty. I'm sharing this with you not to scare you, not to make you panic and sell everything. That would be as foolish as ignoring the warning signs altogether. I share this because I believe awareness creates opportunity. Investors who understand where we are in the cycle can position themselves appropriately, protect their capital, and be ready to act when opportunities appear. Let me tell you what I'm doing with my own money. I've always believed in judging people by their actions, not just their words. At Berkshire Hathaway, we're currently holding over $300 billion in cash and short-term treasury bills. It's the largest cash position in our history by far. Some analysts have criticized this, saying we're leaving money on the table, that we should be fully invested, that cash is a drag on returns. They may be right in the short term. If the market goes up another 20%, we'll have missed those gains. But I'm not trying to maximize short-term returns. I'm trying to protect capital and position myself for long-term opportunity. The way you protect capital is by being patient, by not overpaying for assets, and by having cash available when bargains appear, because bargains will appear. They always do. The only question is when. Think back to 2008, when the financial system was collapsing, when credit markets were frozen, when everyone was panicking. We had cash. We invested $5 billion in Goldman Sachs on extraordinarily favorable terms. We invested $3 billion in General Electric. We made billions of dollars because we had the resources and the courage to act when others were paralyzed by fear. That is the payoff for patience. That's why I hold cash, even when it seems foolish. Now, let me give you some practical guidance, because abstract warnings are useless without concrete recommendations. What should you actually do, given what I've told you? First, examine your portfolio honestly. How much risk are you taking? Do you own speculative assets that you bought because they were going up rather than because you understood the underlying business? Do you have concentrated positions in popular stocks that trade at valuations requiring decades of perfect execution to justify? Be honest with yourself, because the time to be honest is before the crash, not after. Second, consider your time horizon. If you're young and investing for retirement decades away, market volatility is not your enemy, it's your friend. Declines give you the opportunity to buy more shares at lower prices. The longer your time horizon, the less you should worry about market timing. Just keep investing consistently, regardless of what the market does. But if you're older, if you need your money in the next 5 or 10 years, you should be more cautious. You should have a larger allocation to stable, income-producing assets. You cannot afford to see your portfolio cut in half right before you need the money. Third, avoid leverage. This is perhaps the most important advice I can give you. Leverage magnifies both gains and losses. When the market is going up, leverage makes you feel like a genius. When the market goes down, leverage can destroy you. I have seen more investors ruined by leverage than by bad stock picks. Smart people, educated people, people who understood the risks intellectually but underestimated them emotionally. When you borrow money to invest, you are no longer in control of your destiny. Your lender is. And your lender will not care about your long-term plans when they demand repayment at the worst possible moment. Fourth, focus on quality. In bear markets, quality outperforms. Companies with strong balance sheets, consistent cash flows, durable competitive advantages. These are the businesses that survive downturns and emerge stronger. Companies with weak finances, heavy debt loads, unproven business models, these are the businesses that fail. When the tide goes out, you discover who has been swimming. Make you are not holding stocks that will be exposed when conditions deteriorate. Fifth, have a plan. Know what you will do if the market drops 10%, 20%, 30%, 40%. Write it down. Because when the market is crashing, you will not be thinking clearly. You will be emotional. You will want to panic and sell at the bottom. Having a written plan helps you stay disciplined. It helps you act rationally when everyone around you is acting irrationally. Let me tell you a story about the importance of having a plan. In 2008, I received a phone call from a friend of mine, a successful investor who had built significant wealth over his career. The market had just fallen 20% in a matter of weeks. My friend was terrified. He wanted to sell everything. He could not sleep at night. He was watching his net worth evaporate, and he felt completely helpless. I asked him what his investment plan called for in this scenario. He told me he did not have a written plan. He had always just done what felt right, and right now what felt right was to get out. I told him that his feelings were understandable, but that acting on them would be a mistake. That the time to sell was before the crash, not after. That selling now would lock in his losses and guarantee that he would miss the recovery. He did not listen to me. He sold everything. He went to cash at almost the exact bottom of the market, and then he watched his... I remember a man who sold all his stocks near the bottom of the 2008 crash, paralyzed by fear. He watched as the market eventually hit new highs. He watched as his former portfolio would have more than tripled in value. He was too embarrassed to buy back in at higher prices. The last time I spoke with him, he was still mostly in cash, still waiting for the perfect moment to reinvest. That moment, of course, never comes. The lesson isn't that you should never sell. Sometimes selling is the right decision. The real lesson is that you should base your decisions on analysis and planning, not emotion and panic. The worst decisions are always made in moments of maximum fear or maximum greed. The best decisions are made calmly, rationally, with a long-term perspective. I know some of you are thinking, haven't I been warning about market risks for years? Cautious in 2015, 2018, 2020, and each time the market went higher? Am I just a permanent pessimist crying wolf? It's a fair question, and one I want to answer honestly. Yes, I have been cautious for several years. Yes, the market has continued to rise. And yes, my caution has meant that I have missed some gains. But the fact that the market hasn't crashed yet doesn't negate the real risks. It simply means we've been lucky that the timing hasn't yet aligned. Market crashes are like earthquakes. The absence of a major event doesn't mean it won't happen. It signifies press building along fault lines. When the release comes, it will be violent. Besides, my caution hasn't been costly. My company has continued to grow its intrinsic value, earning returns on our operating businesses and strategically using our cash when opportunities arise. We may have underperformed in the short term, but we've protected ourselves from catastrophic loss. In investing, avoiding catastrophic loss is more important than maximizing short-term gain because mathematics is asymmetric. If you lose 50%, you need to gain 100% just to recover. The best way to build wealth is to avoid large losses. Everything else is secondary. Let's consider what this warning signal suggests about specific sectors, because not all stocks will be affected equally. Some areas look particularly vulnerable, while others might offer safety. Technology stocks concern me the most. The largest tech companies have become a massive part of market indices, their valuations assuming continued growth at rates increasingly difficult to sustain as they get larger. Many are spending enormously on artificial intelligence with no clear path to returns. The enthusiasm surrounding AI reminds me of the internet boom in 1999. Yes, the internet changed the world and many companies made fortunes from it, but many more lost fortunes betting on it too early or too aggressively, and the timing of returns was much longer than anyone expected. I believe AI will be transformative, creating enormous value over the next few decades. However, current valuations of AI-related stocks assume a level of success and speed of adoption that may not materialize. When expectations are this high, disappointment becomes almost inevitable, not because the technology fails, but because reality rarely matches the most optimistic projections. Commercial real estate continues to be a disaster in slow motion. Office buildings in particular face structural decline. The shift to remote and hybrid work is permanent. Companies aren't returning to the old model. They're reducing their office footprints, letting leases expire. Buildings financed with debt based on old occupancy assumptions are underwater. This will create problems for regional banks and insurance companies, rippling through the financial system in ways not yet fully visible. Consumer discretionary stocks worry me because the consumer is running out of gas. Excess savings from the pandemic are gone, credit card debt is at record highs, and delinquencies are rising. The consumer has been remarkably resilient, but that resilience is fading. When the consumer finally pulls back, companies dependent on discretionary spending will feel it immediately. Where do I see safety? Boring businesses with pricing power. Companies that sell things people need, not things they want. Utilities, consumer staples, healthcare, insurance. These aren't exciting investments. They won't double overnight, but they'll survive whatever comes, continue paying dividends, and be worth more in 10 years, regardless of what happens in the next 2. I also see opportunity in energy, not because I can predict oil prices, nobody can, but because energy companies have become disciplined about capital allocation. They've paid down debt, increased dividends, stopped chasing growth at any cost, and trade at valuations that assume very little good news. When expectations are low, even modest positive surprises can create significant returns. Let me leave you with this: the signal I've described, the confidence gap, the amateur hour, the institutional capitulation, doesn't tell you exactly when the market will top. It tells you that conditions are dangerous, that risk is elevated, and that the margin of safety has narrowed to a dangerous degree. You can still make money in this environment, but you're taking more risk for each dollar of return, and the potential downside is growing larger by the day. I've been investing for over 70 years. I've seen 14 major crashes. I've watched trillions of dollars of wealth evaporate. And I've learned that the time to be cautious is when everyone else is, well, not. It's not when everyone is cautious that danger looms. It's when no one is. It's when the world seems at its safest, when everyone is making money, when the future appears bright. That's precisely when danger is at its peak, because that is when complacency peaks, when vigilance disappears, and when the seeds of the next crisis are sown. The signal I'm seeing now tells me we're at that moment, a moment of maximum complacency, a moment when everyone has forgotten that markets can fall. I've seen this before. I know how it ends. And I'm telling you now, while there's still time to prepare yourself, not to panic, not to sell everything and hide, but to examine your portfolio, reduce your risk, raise your quality, hold some cash, and have a plan. Because when this turns, and it will turn, you'll want to be ready. You'll want to be the person with resources and discipline, not the one scrambling to survive. I want to delve deeper into something I believe is critically important: the psychology of market tops. Understanding this psychology will help you recognize these moments long after I am gone. At market tops, there's always a narrative, a story that everyone believes, a reason why this time is different. In 1929, the narrative was that America had entered a new era of permanent prosperity. In 1973, it was that the Nifty 50 stocks were one-decision stocks you could buy and hold forever. In 1999, the internet had changed the rules of business, and traditional valuation no longer applied. In 2007, real estate never declined nationally, and financial engineering had eliminated risk. Today, the narrative is artificial intelligence. AI will transform every industry. The companies building AI will become the most valuable enterprises in human history, and anyone who doesn't invest heavily in AI will be left behind. And here's the thing: the narrative is probably correct. AI probably will transform every industry. Some AI companies probably will become extraordinarily valuable. But that doesn't mean current prices are justified. It doesn't mean you should pay any price to participate. It doesn't mean there's no risk. The internet really did change the world, but that didn't prevent internet stocks from falling 90% when expectations got ahead of reality. Real estate really is valuable, but that didn't prevent housing prices from collapsing when speculation got out of control. The danger of a compelling narrative is that it makes you feel smart for believing it. It makes skepticism feel foolish. Everyone who questions the narrative is dismissed as a dinosaur who doesn't understand the new paradigm. And the people who believe most strongly are rewarded with profits, at least temporarily, which reinforces their belief and silences their doubts. I have trained myself over decades to be suspicious of compelling narratives, not to reject them outright, but to examine them critically, to ask what's already priced in, to consider what could go wrong, to remember that even true narratives can create bubbles when they become too widely believed.